Welcome back to another episode of Talking Shop with IG. I'm Luke, I'm your host for the day. And actually, if you're watching this on YouTube, you might notice we've changed things around a little bit. So we've now been given the keys to the TV studio. Rich, Ange, producer Fred have finally let us get access to the green screen. So now we're kind of sat in a bit more of a podcasty kind of place. And for those eagle-eyed amongst you, I'm not only joined by Sean, which is founder regulator. We're also the staple member. We're also joined by Ronni Agnew. Welcome to the team of Talking Shop, Ronni.
Thank you for having me, guys. Feel honored.
Well, we needed someone to replace Pete Ward because he's left us for the week, and I thought none better than bringing in a man like Ronni. You've been ripping it up on IGTV, Trade Live with IG, so we thought we'd bring you in.
You know, I have been doing my best to get my exposure in, compete with these guys. Luke is not telling the full story. He did offer it to two people before me. Then, when those two people couldn't do it, I stepped in. But now I'm like Mario Götze 2016, ready to jump in.
This is it.
He's worried you're trying to steal his thunder.
Exactly.
Place of IG.
Can't outshine the master.
Don't let the beard fool you. He's still a baby. He's still a baby. But let's see. Ronnie's been with us now in the premium client team for
7 months?
Yeah, seven or 8 months, doing a fantastic job as one of our account executives. So welcome to the team. What are we talking about? Now, we're continuing our Tradecraft series, and we spoke last week about the maths. This week, we're trying to talk about the brain a bit more, okay? So this week's all about bias. What is bias? What does it mean? How can you use it to your benefit? How can you be aware of it to kind of so that it doesn't act against you? And we're gonna kick off with a little definition, if that's all right. So the Corporate Finance Institute, the CFI, defined bias within finance, a predetermined disposition of one position over another. Usually, when the trader is biased, it can hinder proper decision making when trading because it can prevent a proper judgment. The trader may therefore end up acting on emotions rather than well-rooted analysis.
Sounds like me, yeah.
But do you think most people come to trading driven from a bias, i.e. been given a get-rich-quick scheme or this is definitely going to happen? There's not the pre-plan that we spoke about in the previous episode. So I think most people are lured into trading from a bias perspective, and it's quite hard to then unwind that because, and again, certainly talking about last episode, if it's successful, you'll continue doing it. Mm. And then it kind of reaffirms the bias. I think I'd go so far to say is a lot of people start from a bias perspective.
Bias or ambition, you've got to be really careful because, of course, everybody turns to trading as a way to make money. Luck in the early days can give you a type of bias that we're going to talk about, but there are loads of different types of biases. So we're going to focus on the three main ones. We're going to talk about confirmation bias. We're going to talk about gambler's fallacy. And we're going to talk about loss aversion, which in my mind is huge. Loss aversion for me is the biggest one. But there are loads of different other types. So hindsight bias, the ability to look at hindsight as 2020. You know, why didn't I take that trade? I wish I would have done. Yeah. Availability bias, making a decision based on information that is readily available at the time. You know, everybody could look at the FT and then make a view. You can make that information available. An interesting one I saw that we're not going to dive in too much detail now is anchoring bias. So where the first piece of information you interact with is what gives you your bias. Mm-hmm. So I'm going to start with just asking you guys, can you share a moment when you felt bias?
Ooh, I have a good one for this. So it was when I first started trading with a competitor, who I shall not name.
But you're not allowed to trade with IG.
Exactly.
That's the reason, right?
But this was I was 18 or so, and I'd been trading on a demo account. And I thought I was like Axel Rudolph. I thought I was a technical analyst king. I looked at the chart and I say like, okay, it's gone this, and this. Now it's going to go this. I took some trades and I made a lot of money on my demo account. I continued this on a live account and I like doubled my money in 2 or 3 days. And then I said, right, so this is going to continue to happen every time. Like I've cracked the codes to markets. And I think it was oil. And I just took a massive long position, leaving absolutely no margin on the account because I'd done the exact same thing 4 times before. And then I did it again. and it just tanked. And I woke up the next morning and my account was on zero. That was all my savings as an 18-year-old. So it was pretty heartbreaking. But yeah, that was a tough lesson to learn, to swallow. Like, just because it worked once doesn't mean it always will work.
Yeah. I mean, I've been in markets for so long, and probably every bias I've probably had at some point. But I guess the most recent one that is a standout is the sort of crypto frenzy. Just sort of buying it without any pre-plan, then just sort of almost, we're going to touch on it, confirmation bias. You just read positive stories about it without actually really knowing. When I look back, my initial view was the Emperor's New Clothes. I had no idea what it did, blockchain, all those terms. And I just made money, and I got lucky that I didn't lose money. I was definitely just trading without any real logic. It was just, I guess, touching on a bit of FOMO as well, but just in it and in it and in it, and just thinking, oh, it's just going to keep going. Maybe gamblers, fallacy as well. It's worked, so it's going to keep working. So yeah, I think crypto is a standout for me.
Yeah, I mean, for me, do you remember Blue Jay Mining?
Yeah.
This still gets banded about once a week.
This stock. I mean, this was kind of 2017, I think, 2018, right? And everybody was talking about this stock, a penny stock. It had gone from like 2p up to 20p. Had the biggest store of some mineral in Greenland that had to do something with to do with paint. It was the biggest asset ever. And it was this huge promotion, right? Loads of people were talking about it. Not being aware of my own bias, I hear people talking about it the whole time, right? Everyone's saying, this is the stock, this is the stock. So I remember buying at 18p. I remember buying at 22p. And I guarantee I top ticked that flipping thing. Soon after that, I was the reason why it came down. Clearly, I was last of the story. It was almost like the taxi drivers were talking it, and this thing just fell. They've since raised money. Turns out it's bloody difficult to build a mine in the middle of nowhere in Greenland. Do you remember a friend of our show, James, had been on a trip recently with one of his clients to Greenland, and he said it's so vast. It is so vast. They have to raise so much money to build the infrastructure. Yeah. Anyway, my confirmation bias. I was looking at this thing through rose-tinted glasses. It could not go down. Lo and behold, yeah, it's now worth, at last check, a third of 1 penny. It's got a different name to try and shake the moniker of it. And yeah, if you're invested in it, come to me. I'll we can go for a drink. We can talk therapy. Which brings us on to confirmation bias, right? So this is where we start to get into the meat of what we're going to talk about. Confirmation bias. It is the tendency to focus on information that supports your pre-existing beliefs, and you ignore contradictory evidence. How many times do we hear clients say, it couldn't possibly go down? You're reading all these news stories. Trump is a great example. Trump, he comes out with some ridiculous things. Politically, he's very charged. I remember in his first term, everyone thought the market was just going to completely crash because he's a lunatic, he's a cartoon character of whatever. And this thing just roofed in the face. And people were so hung up on being offended or jilted or kind of taking his politics into view, that they would short the US stock market because of that. And no matter what, you just could not get off that.
Yeah.
That's the problem, really. Like when you think about these sort of stocks that you have or politics that you have a sort of moral view on it, the market doesn't have a moral view. They don't have any ethics. They don't care. They care about the results. They care about the figures. They care about the outlook. And I think that's the really problem when you mix in your other, you should only use your brain that's focusing on, the statistics, what's actually happening, and not your sort of humanitarian brain, because that won't cut it. Look at ESG. I mean, it's not giving the results that you want. And when you mix that in, that's when you end up on the wrong side of the trade.
Yeah. I think confirmation bias as well is you can get it across all time spans in terms of trading plan. So I think a lot of people get caught in confirmation bias when they're offside. They'll be in a position when they've got a trading idea, it goes against them, and then all they do is look for news to validate their original pre-trade idea, which since it's been put on has been proven incorrect in the short term. They're looking to validate when they should actually be trying to challenge it and say, is this going to get any worse? What's the maximum risk I'm willing to to risk on it? But you also get very short-term ones on knee-jerk news. Things about something like, the mini budget. Went into that weekend at 110. what was it, September 22 or something like that?
Cable.
Yeah, cable went in at 110. I can't get any lower. People buying it ahead of the weekend. Monday morning, 103. Absolute shocker.
Well, it's the same recently happened, right? Nvidia can't possibly go down. The US stock market can't possibly go down. I think the biggest example I've seen of confirmation bias, Ronnie, were you even in the markets at this point? Pre-COVID,
no.
I'm guessing no. Do you remember Tesla Q? Do you remember these guys?
Tesla Q.
TSLAQ. Do you remember seeing this all over Twitter?
When was it?
No.
So the idea behind this kind of community was they were so biased against Tesla, right? And this is when the stock in today's money was trading like $30, right? It's now trading thick end of 400. And the idea being that when Tesla gets delisted, the stock ticker gets a Q put next to it to say that it's like a disqualified share. And Tesla Q was an echo chamber of negativity. And everybody was confirming their own bias. Like, I remember seeing a story of, the early days, the reports of Tesla when they were trying to ramp up production, they were low quality cars, right? The giga presses weren't working properly. And every time there was something slightly wrong with the car, Tesla Q would light up. This thing was like someone, I remember seeing a picture once of a Chinese, one of the Chinese gigafactories with a parking lot full of Teslas. And one of them had a crack on the windscreen. And like the army of Tesla Q guys, someone had got in and taken a photo, and then he put the drones up, and you see, there's hundreds of these. They're all this is worth, millions of pounds worth of stock. And people were piling in short. Now, this was the time when, EVs were just kicking on, rates were zero, everything was moving in their favor. They were raising money at high prices to be able to then go and pay for all these things. I lost countless clients trying to short, and everybody was pointing at Tesla Q as like, there's all this very well-founded research, right? You can't deny these guys are going and doing the legwork, but fundamentally could not escape the view that Tesla was going to go to zero. And look at what it is now. Yeah.
Do you think there's an order to biases? As in, so confirmation, does that lead to gambler's fallacy? Does that lead then onto risk loss aversion? I wonder if there is a process where one leads to another.
Well, I think you look at the whole picture, right? As a human, we're probably, I know that we're not built for this, okay? Trading is a weird game. We're built for fight or flight. Hundreds of thousands of years worth of biology, we are built for fight or flight. We're not even built to look at screens, right? That's why I wear glasses. It's why, we've all got backache. We're not built for this. Trading's a weird...
emotional, right?
We're emotional. Yeah. And Ronnie, as you alluded to earlier, you've got like the kind of caveman brain, and then you've got the kind of thinker's brain.
Yeah.
And when things don't go your way, the caveman brain overtakes.
Yeah.
Because you might have some logical plans, you might have some things set in place, you might have some rules, you might have some stops. But as soon as the caveman brain starts to overtake, you're moving stop losses, you're buying the dip, you're kind of adding to a loss-making position, you're fiddling around with it.
Yeah, that's the sort of fallacy that we always tend to have. So I remember we had this one stock in Sweden, it's called Fingerprint.
Fingerprint cards.
Yeah, you guys remember it, yeah? So they were early on with the fingerprint sort of reading technology. And so when iPhone and Android and all of these guys came out with the home button of fingerprints, they just roofed. Everyone was talking about it. I was working at a hotel at this time, and I was a waiter. Not even a waiter, I was below the waiters. And the waiters and everyone was talking about it. I'm putting all my pension in this. I'm getting out of this. I'm going to get out of it. And then, face scanning comes out, and the stock's worthless. Now it's trading at 1/100th of what it used to do. But everyone was saying, no, it's impossible. It'll come back.
Everybody's confirming.
And you look around, the other waiter's saying it's going to come back. The third waiter's saying it's going to come back. And you say, hey, we can't all be wrong. What you're. And I was talking to one of our clients the other day. He's a big short seller. And he was saying, as soon as I place a trade and I know that it's the wrong, I feel it in my gut. But in the beginning, he's like, what differentiates me from now than 20 years ago is I don't ignore the gut feeling anymore now. So he has that sort of caveman thing where he just goes to his emotions and feels like, all right, I'm wrong, get out of it. But what he did 20 years ago was, all right, I'll just stick to it. It's going to turn around. So you always have to sort of fool yourself almost a little bit.
Well, this is why Tasty went on tour around the US called the unlucky investor, right?
Yeah.
Every trader's an unlucky investor. So look, what do we do about it then? Okay, so Warren Buffett, the big man,
The GOAT.
the GOAT, right? He says the biggest thing to try and get around confirmation bias is to diversify the inputs to your decision-making process. Okay, so you've got to use a variety of sources of information. And there's a really good website that I can recommend to everybody called ground.news. And these guys, what they do brilliantly is you create an account, and they're a news assimilation website. And what they'll do is they give you a score of left versus right. And so if you naturally find yourself reading kind of left-leaning articles, it will have a thing that says, you have not seen this, this is in your blind spot because it was written in the right wing. And so you've got an ability to then try to, get out of your echo chamber. So Big Buffett says diversify your sources. Ground.news. It's brilliant.
Never heard of that.
Ground.news. They were a YouTube sponsor on Porter's website, a YouTube channel that I watched. They're really, really good. Peter Lynch, who is a famous investor, he says, look, you've got to set specific criteria for making your investment decisions before you enter the market. It's what we were talking about last week.
Yeah.
It's being mechanical, stops, entry conditions, drawdowns, P&L ratios, percentages of your account, because then it kind of becomes a numbers game, as opposed to a feeling game.
Yeah.
It's sort of like I was reading like an old interview with. Do you guys remember the hedge fund Tiger Management? Now they have like the Tiger Cubs.
Cubs.
Yeah. So he shut his hedge fund down during the dot-com bubble because he had his, like David Lynch says, he had his sort of, Peter Lynch says.
Peter Lynch,
not David Lynch, our colleague. So he had his sort of like set criterias of what he was going to invest in and what sort of ratios he was looking at. I mean, if we think that the US markets are overvalued now, trading at what, 25 times forward PE earnings? They were trading at 80 times during the dot-com bubble. And he just refused to invest in these dot-com stocks. His traders quit because they say, we're missing the rally. His investors say, why are you not investing in this? And he's like, this is not part of the game plan. This is not the criteria that I have. And he shut down his fund rather than investing in these stocks. And,
which he would have been ridiculed for.
Exactly. Yeah. And now, with the answers at hand, he was the right one because he had a clear set of methodology that he followed.
Is that hindsight bias, though? Have you got hindsight bias?
Well,
let's. I mean, you're completely right. I mean, one other thing you can do that was actually suggested by a kind of a professional poker player called Annie Duke was take a personality test. Try and figure out where you're susceptible to these things. And I found a website called 16personalities.com. You can do a 10-minute personality quiz, and you can check out where your blind spots are.
I'm afraid of the results of that one.
Do you think someone like the Fed, remember coming out of COVID, the whole inflation is transitory.
Mm-hmm.
Do you think they were ignoring data and therefore had some sort of confirmation bias? With data, everyone was saying you've got to raise rates.
Yeah,
you're too slow to act.
You can totally see that.
So it's not only average Joes like us who get it wrong.
Oh, yeah, but it happens in every walk of life, right? How many times do you drive down a country road and you're convinced you're going to find someone that's driving like 10 miles an hour below the speed limit? You've got that confirmation bias. It's just always going to happen.
Yeah.
Let's move the game along, please. And speaking of games, we're going to talk about gambler's fallacy. Now, have you ever heard of something called the Monte Carlo fallacy, gents?
Yes.
I did.
Yeah?
In my research in this. Yeah.
We've taught them well, guys. Okay, who wants to furnish us with the Monte Carlo fallacy?
Isn't it the fact that, so you think that just because something's happened several times, surely it's going to change. So, for example, like in the roulette table.
This is it, right? So what happened in 1913 in Monte Carlo?
Wasn't it that it came on black like 76 times in a row or something like that?
26.
26.
That's what I meant. It's just the pronunciation. You guys are misinterpreting it.
Yeah, so the Monte Carlo casino, one of the world's most famous casinos, famously on the roulette wheel, the ball came black 26 times in a row. And every time that it did, people were betting that the next ball was going to be red, right? But every time the spin of that roulette wheel goes around, it's not 50-50 because of the two zeros. So it's something like 48.5 green, 48.5 red, with the other two being zeros. The coin flip came out tails, aka black, 26 times in a row. So what does that teach you?
It goes back to the previous podcast of Axel. Is how many trades, incorrect trades or wrong trades can you have in a row? People just go, oh, I won't be wrong next time.
Yeah.
Well, to put it to you, right? Have you ever thought stock was due a bounce back because it's down?
Oh, yes.
everyone has.
Oh, yes.
Everyone has.
Or how many times have you made a loss-making trade and you revenge trade to get back in because you've lost 3 in a row and you go, the market owes me. The market
Angry
owes me.
trading's never good.
Yeah, I mean, for me, it was mRNA,
Moderna, yeah.
right? I got fully through my confirmation bias. It was a podcast that I listened to during COVID, and you were thinking all these RNA vaccines. This is the best thing ever. We're going to be able to solve COVID. Done. We brought a vaccine to market. Everyone's going to be, everyone's saved. And then they said, right, they're going to take aim at cancer. And at the time, some family members were going through it. I was like, this is fantastic. This is going to be the best thing. This company has to continue to keep growing. Since then, it is down 91%. Right? But every time it dipped, I thought everyone's got it wrong. It's dipped yesterday. It has to go up today.
Yeah.
And it didn't. And it kept dipping.
Yeah.
And it kept dipping. It's still on my watch list because I'm an addict and a junkie, but I cannot take it off my watch list because it's going to turn. But I'm aware of it that, the past events do not influence the future.
Yeah. That angry trading and that sort of revenge trade. And I used to work with someone who's brilliant, who used to just sum it up well. So we'd be sitting there and it'd be a big move and you think, oh, market's got to go up. It has to go up. I think this is going up. And he would, without looking up, without coming up above his screens, market doesn't give a what you think. And he would just completely go, you've got to base it in facts. You can't just keep saying, I think this is going to happen, this is going to happen. Market doesn't give a what you think. But it's great.
Yeah, my recent one that I had, which was just now, when back in December, when Novo Nordisk came out with that the weight loss of the trial showed about 22.5% weight loss rather than the expected 25%, and the stock dropped like 20%-ish or something. I said, mate, this is my time to buy Novo Nordisk. And it's been on that. It's been in and around that ever since. It hasn't bounced back. It's still on that same level that I entered on. And it's just because it came down, I thought, okay, but it went up all this way before. Surely now it's going to come back to the levels. Everyone's going to buy the dip just like me. But no one cares about what I'm doing.
I've lost, again, look, we talk about the Tesla trade. I've lost so many clients over the years trying to short the DAX, right? The DAX has probably been one of our most popular products. Certainly in the 11 years that I've been here, I know everyone's trading a bit more of the NASDAQ these days. But so many people are just trying to short it because they think the German economy is the same as the German stock market, and it's not. The German stock market's full of these big, cumbersome manufacturing companies that don't take much to get a move on, super sensitive to market risk. Yet they'll say, okay, because the FTSE's up, I'm going to try and trade against the DAX. And it's just, one thing does not mean the other one. And you just keep shorting it and you go, right, well, this thing is it's taking all my money from me. I cannot get over this thing. I'm going to have to kill it to win.
Yeah.
And you just lose this thinking side of your brain to it. And look, I mean, the impact is it can go two ways, right? You can hit lucky, you can get a hot hand, to borrow another poker phrase. You can get overconfident and you can try and take more risky bets. What did we say last week was the biggest killer of retail accounts? Not using stop losses and having your position sizing wrong. So if you're on what you believe is a hot streak and you just go, right, everything I touch turns to sold here, right?
Yeah.
Who was it that said that? That was, it was on The Apprentice.
Was it?
I
never watched The Apprentice.
One of the wide boys on The Apprentice. Everything I touch turns to sold. But you get to a point where you think, this is it. I've got this. I've cracked it, right?
Yeah.
What you said. But then you just don't, inevitably, because you start to forget your fundamentals. You start to forget risk management because you're on this hot hand, and you start to think that because
it's just sort of like Icarus dilemma. You fly too close to the sun, you get burned because you think that you're untouchable. But the market does not discriminate against anyone. Yeah. Anyone can get it any day of the week.
Yeah. Gambler's fallacy. I've seen people in positive positions, gambler's fallacy, and it go horribly wrong. I can remember Gulf Keystone was one.
GKP.
People were buying it all the way up. I can't remember exact price, but sort of buying it all the way up, adding, so rolling their profits into more positions, drilling update. Oh, there's no oil, it's water. Bang. Money's all gone, left to debt. I've seen it after the financial crisis, people buying banks all the way up, thinking it was never going to end, pull back, done. Yeah. So you can get it in the positive sense as well. You don't have to start from a negative. Almost that positive reaffirms, you lose sense.
Yeah.
So what do we do about it then? How do we help people?
I think you have to sort of be critical to what you're doing. And just as you're critical to your losses, you realize, okay, what did I do wrong here? I didn't put my stop loss. I didn't manage the percentage of my account that I put into this. you have to be just as critical to your wins, right? Because just because you're winning doesn't mean you're doing something right. You could just as well just be lucky.
Yeah.
So you have to sort of build up your patterns. Just as you look at the charts and build up a pattern, you have to look at your trading history and build up a pattern and see, when I do this, when I have this sort of methodology, it goes well, and here's what happened. So always sort of analyze and try to build up a methodology to what you're doing.
I think you have to fact check a lot as well in terms of when there's new information or new news.
Yeah.
What impact does that have? You have to sort of look at the facts, and I think that's key. People just kind of continue to use the same thought process when there's new information.
Yeah.
So when the facts change, so should your opinion, right? You need to reevaluate. And using this gambler's fallacy, I don't know, something like I know you will know people who've got 4 boys or 4 girls. There's an element of gambler's fallacy there, right?
Yeah.
But those will go.
Speaking from so hang on, how many kids have you got these days?
4.
4 at the moment.
Girl, boy.
Yeah.
So there was no gambler's fallacy.
Cracked it.
But I know people have gone, the logic is it's 50-50, right? But they'll go, oh, it's got to be a boy next.
Yeah.
It's got to be a boy. And I know people who've got 6 girls.
6 girls.
Bloody hell. I mean,
But again, that goes back to it, right? The facts are, it's 50-50. It's not more likely the outcome is going to be different. So, yeah.
I like, shout out to our friends over in Chicago, Tom Sosnoff, who I think is one of the leading kind of people in the discussion around mechanical trading. What he says is be absolutely ambivalent to the underlying. Doesn't care what he's trading. But for Sosnoff and the team at Tasty, options are very kind of mathematical and probability based. In the UK, I think we've got we have this kind of knowledge. We're nervous of them because they're complex, right? And their take is complexity is good because it means you have to work at it, and actually that gives you other things in your life, right? You kind of be disciplined, and they really like it. But he says he doesn't care what it is, right? Look for the setup, look for a probability of profit, be strict with your risk management, and actually it doesn't matter what it is. You could be trading the euro, you could be trading, Palantir, you could be trading whatever if the setup is correct. So be aware of what you're trading and having that story behind you to try and take that away. Right, we need to move on. Because we are chatting too much.
That's Ronni.
That's Ronni, yeah. Well,
sorry, guys.
Not at all. The big one, right? This for me is the big daddy of problems: loss aversion. Anyone got a definition for the gang?
Whoa.
I have one.
Go for it.
Short one. The tendency to hold on to losing trades longer than we should because we fear realizing the loss.
Yeah. I think, and we alluded to this on the previous podcast. In life, losing means it's horrible, right? I've lost. I've come second. The world is built around winners, right? And we're not talking about the kids' sports day right here. There, everyone gets a prize.
Yeah.
We're talking about losing is fundamentally not something that we deal with. If we're presented with a challenge, we fight or flight, right? With the expectation that we come out and we win. This emotional impact we have with losing really impacts trading, because trading, we know, and we looked at it last week, you can run a trading strategy with a 30% hit rate, meaning you're going to lose 70% of your trades. You can run a 50-50, right? You can flip a coin, you're going to lose half your trades. Losing is part of a strategy. That's part of a profitable strategy. And so it should be seen as almost like a piece of working capital. The term loss aversion, to add to your definition, Ronni, it was first identified by 2 psychologists, and I'm going to absolutely butcher their names, Tversky and Kahneman. And the theory suggests that if 2 choices are put before an individual, both equal in terms of monetary value, so here's £5, or I take £5 away, right? Your net change in wealth is 5. Every single person goes for the gain, right? No one wants to take the £5 loss, even if they then started to kind of tweak the study to say, right, you can take the £5 loss now and you'll get £10 tomorrow, or something like that. They still all took the higher present value and took the £5. And there's been loads of studies that have done into it, right? The emotional impact of a loss, it's actually believed to be twice as strong as the impact of winning.
100%.
I think I read something similar along the lines of, well, they did a study where they gave people outcomes. I can't remember what the exact outcome was, but one was just solid. There's no negative here, but this is the benefits. There's one negative, but the overriding outcome is better than all the positives here. And most people took all the positives. Just because there's a hint of a negative there, they wouldn't accept it, even though the outcome was better or beneficial compared to the other. So I think that goes for trading as well.
I've actually dug up an interesting example of this. Are you guys familiar with Bill Ackman, CIO and of Pershing Square? I think it's
Pershing Square.
yeah,
Yeah,
it's
Herbalife.
Herbalife Giza.
Yeah.
That's the one. He got a proper short squeeze there by
Herbalife Giza.
he got a proper short squeeze. Before I dive into my example here of him, did you guys watch the documentary on Herbalife? When he did a documentary about his Herbalife short, and he was going to these like immigrant communities who were being sort of tricked into joining this scheme or whatever it was, and he went to this like Mexican church where no one spoke English and everyone came with just the clothes on their backs, and he's saying, yeah, you know, I'm from an immigrant background as well, you know, my great-great-grandfather was Irish. It's like, man, come on. Anyhow, that's not the biggest L he took. The biggest L he took was a pharmaceutical company called Valiant.
Valiant. I remember these guys.
Yeah.
VLRX, what was the ticker?
Yeah.
Like
So they had, their strategy was, instead of spending all this money on R&D and developing a new drug, we're just going to buy up a bunch of small companies, medical companies, and we're just going to build a portfolio like this. And, you know, they got a lot of praise. They'd cracked the code of growing a pharma company. Bill Ackman built up into the position all the way up to $250. Started coming out that they're manipulating their balance sheets. They're obviously hiding all the acquisition costs, and they're not really taking all of this into consideration. This started to come out. He continued to build into his position while everyone was going against him. As he said, the facts changed, but his opinions didn't. So he ended up, the stock fell from $250 to $10 until he eventually closed out. And he lost $4 billion on this.
Mm-hmm. So he just didn't take the pain?
He didn't take the pain. And then he got an even bigger pain to take because he refused to take it on the chin.
Yeah, zero risk management. I mean, we speak to clients all the time, and you see people that are that have got their trade analysis tool, which is the piece that we were speaking about again last week. Sorry to keep plugging the episodes, but genuinely for listeners, what we did last week was a real deep dive into the statistics, and this was the start of our kind of Tradecraft series. But we speak to people so often, retail clients, that have got like a 70% profit ratio, right? They're winning all their trades, great, fantastic, that you're closing, rather. So sorry, all the trades you're closing are profitable, and then you look at open positions and it's a complete car crash. Right. Yeah. And it's so sad to see that we can continue to keep talking about these things, yet actually putting them to practice is so freaking hard.
Yeah.
It leads to things like over trading. Right?
Yeah.
If you're in the hole, if you're on tilt, right, in poker, if you're on tilt, you're making decisions that are not based on your plan. And that loss aversion motivation is so strong. Yeah. You know, as soon as you see a loss-making position, if you don't have a stop on it, you then probably buy the dip, and you're now adding to a loss-making position, which we know statistically is a terrible idea. Yeah. You are moving stop losses because you go, I'm not feeling this, I'm going to lower my stop, I'm breaking my plan, I'm breaking my rules. Again, you know, we can model it to the nth degree, but these things are low edge. Think about it. If you had a risk manager on your shoulder and someone was holding you to account, they're going to look at you and go, what on earth are you doing? Yeah. And that thinking, logical brain that you have when you put the trade on is out the window. The caveman's in control. Yeah. Right? The caveman's in control. He's beating his chest. You know, you're scared. The market's going to tell you you're wrong. But the market, again, it doesn't owe you anything.
No. I think you're right. I think this is by far the biggest one. Like, it's huge. And I've had examples where you speak to clients, like you said there, Luke, their win rate's 90%, 95%. But what's more worrying is they don't see the link to their open P&L, because in their mind it's not a loss, but they'll go, oh, it's fine, when that comes back I'll be fine. But they don't link the two. They just think they're a rock star trader and that'll be all right. In a few months it'll come back and I'll be absolutely fine.
What happened to me, right? I didn't cover my Blue Jay position. I could have got out of that at scratch, right? As soon as the tide started to turn, instead I took a 70% hit on it. Blew up my ISA. I didn't have too much money in my ISA at that point because I was just a wee whippersnapper, just a couple of years older, maybe, or minutes older than Ronni was. But, you know, you just struggle with this thing.
But I think you're right. I think that the problem is people are so uncomfortable taking a loss when, I don't know, whether you're looking at percentages or actual monetary terms. Let's say you're down 10 grand. I can't take a 10 grand loss. Okay, well, if I spoke to you in a month's time and it's 50 grand, you'd have happily taken that 10 grand.
Yeah.
So kind of in a way, you've kind of just got to go, right, that's it. That's my pain. I've drawn a line under it. And I coach a girls' football team. And when we have a bad result, I tell them there are no success or failures. There are only outcomes.
Yeah.
But it's how you interpret it. So I think people need to be comfortable with that. Take the loss. What have I learned? What could I do better next time?
It's the Conor McGregor model, isn't it? His book was called Win or Learn. No, excuse me, it wasn't Conor McGregor. It was his coach, Coach Kavanagh. When he was on top of the world, Coach Kavanagh is this Irish MMA coach, and his book is called Win or Learn. That's what it is. And I think we have to continue to push the rhetoric that you make a trade is a shot into the unknown. Okay, you're taking a view to try and guess the future. Who knows what's going to happen?
You're skewing it, given some research and some background, some analysis,
which we know
trying to get it in your favour, right?
Which we know could be biased.
Yeah.
Could be.
You've got a mate down the pub that said, Blue Jays the next big thing. You're biased to then look for reasons why that's the case.
Yeah.
But you can do all the research in the world, but you can't predict the future.
Mm-hmm.
You don't know when the next COVID is coming, next Black Swan is coming. No one can predict that, right?
No.
There's always an element of insecurity there.
Well, tell me who called Nvidia to be down 17% on the open 2 weeks ago?
Yeah, that was a shocker.
Yeah.
No one, right?
Yeah.
DeepSeek, this relatively unknown LLM model comes out, and all of a sudden your portfolio is destroyed because you haven't managed risk.
Well, because before that weekend, there was no real challenge to them, right?
No.
And everyone was like, it can only go one way.
Yeah.
And again, that is that confirmation that.
Yeah. So look, what we're talking about here, loss aversion, to kind of just summarize the topic. Actually, the one thing I think is really interesting when it comes to retail clients is cash on file versus your account's equity. Okay. How many times do you see someone that doesn't want to take the loss? An example is if, let's say, for example, you've accidentally closed the trade, right? From a trader's perspective and from a broker's perspective, the way that we'll approach that is if you sell something accidentally at a price of 10, and by the time you buy back in, it's 11, you've realized any P&L on that first trade, right? That's gone, okay? Yeah. It's come from unrealized P&L, it's now realized P&L. Yeah. You buy back in at 11 and the market hopefully moves back up in the favor, right? What does that cost you? I know because I've spoken to so many people, they'll say, well, it's cost me my realized P&L. Let's say you bought at 20 and you've lost 50%, right? No, it hasn't. You've bought back in at 11. So you've sold at 10, closed, you've bought back in at 11. It's cost you 1 penny. Yeah. Now, depending on the situation, depending on how quick, it could be something maybe first time, we might be able to do something with you to help you try and get back into that. But the amount of clients that will say, no, I want my P&L refund from that first trade, because that cash figure is what people are valuing their account at, which it's just, cash is not king, equity is king.
Yeah, I have calls every single day with clients who get stopped out. They call me and they say, can you put me back on? And every time I say the same thing, you're in a better position to get back in now.
Oh, if the market continues to fall, you're in a wrong position. You've sold at 10, the market's now at 7. Buy back in at 7, it's cheaper.
Yeah.
Happens
now
all
I want to go back into my open level.
Yeah.
But it goes back to that point I was making about the study, right? The benefit, the outcome is far beneficial here. No, but I can't take this hit. Psychologically, I can't take the negative P&L. It's just absurd.
You're just growing the unrealized one.
Yeah, absolutely, yeah.
And another common thing that we see with people that are loss averting is being both long and short at the same time.
Yeah.
It's spread betting and CFD trading, our bread and butter, is over the counter, right? So you can open a long position and you can open a short position. Now, I personally don't recommend it because I use the analogy when I talk to people that do this is imagine you're in a pub and you've bought a beer and you get a receipt, right? Ronni, in your instance, it's a soft drink. Okay?
Yeah, exactly.
Right? We've bought a soft drink, we've bought a beer, you get a receipt. And then you straight away sell the pint back to the bar or the soft drink back to the bar. You've now got 2 receipts. You've got nothing in hand, right? Yeah. That price of that drink can move wherever. You don't make or lose anything because you've got no exposure, right? But what you're doing by having that long and short position is your loss-making position, which is typically where we see people then trade against it. You don't realize that loss. Yeah. And you neutralize it, right? And so people talk about hedging strategies. I think sometimes it might make sense if you've got a long-term view on something with a long position that you've been adding into and nurturing, and you think over the weekend it might go down, so you might neutralize as opposed to take it off. More often than not, it's more expensive to do it that way. You might as well take it off. But that to me is, if we're talking to you and you're listening to this, and long shorts are something that you do, if you know that you don't take P&L off the table, or you don't trade with stops, these are key indicators that you've got bias, right? Yeah. And so how can we advise people to not do this, right? Howard Marks, Oak Tree Capital. So he said that you have to start small, right? If you're a new trader and you've got a small account and you're confined by margin, you don't have the ability to trade that big. If you start small on 10 pence, 50 pence, £1 a point positions with very rigid P&L, psychologically you're kind of conditioning yourself that losses are part of the puzzle. So when you do scale up, you're not scared by that. The fear, that kind of caveman brain doesn't overtake you.
Yeah, and look at the success of Howard Marks. He's a contrarian at heart. You know, he's piled into like these sort of distressed companies, distressed assets, because the confirmation bias of everyone else, they're just reading the negatives about it. And he sees that there are potential. He's a contrarian, so he doesn't fall into these biases. And look at the result of him. How many billions is he managing?
I think as well, there is, I often put it to clients that the difference between someone who would be considered a professional trader, or someone that does this for a hedge fund, or someone that does it for a bank, they have people telling them the rules, right? So they'll have a risk manager, they'll have a compliance manager, they have their head of dealing that tells them how much risk they're able to take. Retail traders are more flexible than that, which is to their benefit, but also to their detriment, because it means that you don't have someone there taking on it. So one of the pieces of advice, and actually to kind of bring this discussion to its conclusion, and then we can get onto the margin call, which we know is the reason why people stick around this long, is to summarize it. So gambler's fallacy, loss aversion, confirmation bias, along with all the other biases. Let's just sum it up in a couple of points. What would you say is the number one tip that if you are aware of these things, what can you do about it?
I think, given the loss aversion is the big one, I think it is be comfortable with the loss, because I think that one then leads you into other biases. Honestly, I think if you're opening a position and it's incorrect, you then sort of delve into confirmation bias, gambler's fallacy. If you are getting, again, to go back to a previous episode, pre-trade parameters, stop and limit, be disciplined, be comfortable with that loss.
Yeah, I mean, you're absolutely right. The loss aversion is the sort of gateway drug to all of the other ones.
Yeah.
But the one thing I would say, borrowing for Sean, is if the facts change, so should your opinion. Don't be afraid to change your mind. It's not your political view. It's just the view on what's happening next in the market.
Yeah, it's not a football team.
Yeah, exactly.
Yeah.
You can change your view.
You can totally change your view.
Going back to your point that banks and stuff like that, they have all the parameters set for them, but they also have research teams and producing notes and giving them new information. So they've got a leg up already, right?
And there's plenty of sources out there. I mean, I actually think one of the big ways to actually kind of start to be conscious of your own bias is talk to people, okay? And trading in itself, right? IG is an app on your phone. It's a website that people visit, and it can be quite lonely. Like when we speak to clients and clients come to events with us, feedback that we often get is that having that ability to network is really helpful. You know, I'm going to plug the show here, but Trade Live with IG every morning at 7:30. If you want to get a little bit of more Ronni, if you know what I mean.
Or Luke.
Ronni. We still haven't convinced Sean to come on the show yet.
No chance.
Having this recorded and on screen, it's jarring up Sean.
Absolutely.
But talk to us, right? We run a trading room every morning, 7:30 till 10:30, and all of the guests, when we're in the studio, we can see the chat. Clients. It's becoming a process where clients are talking to each other and sharing ideas and say, what do you think of this? I like this. And people are contributing. So I think having that community is really strong. So I would also say to kind of echo what you guys are saying, have a plan, stick to it, take multiple sources of information in, be aware of the style of writing and what you're reading, right? Try not to listen to it in an echo chamber, and try and externalize your opinion. Because I know personally that if I bottle something up, I don't talk about it, I'm going to probably get it wrong. We on desk, all we do all day is talk to each other about certain client stories and ideas, and is this the right way to approach this discussion or not? You've got to be like that.
I think that accountability is key. I hadn't thought of that. I think, like I say, vocalising, even if it's in a community sort of chat, someone's going to hold you accountable. Someone's going to call you out. Yeah. So there's something in that. And I've got a client who says it's a lonely game. He trades himself at home all day. He will literally talk out loud his trades because he thinks that gives him some accountability. So I think it's a good one.
Everyone needs a cynic like Sean in their life.
Oh, yes. On that note, let's bring in the margin call.
Let's move on to our favourite section of the week, the margin call. The margin call, for those that have just joined us for the first time, it's our favorite section of the week. We want to break down out in the market of the last 2 weeks, who is the biggest loser, right? Who's taking the biggest L? Who's on margin call? Who's getting the phone call from risk and saying, you need to do something about your positions. You need to check yourself before you wreck yourself. So our guest of honor today, Mr. Agnig, we'll let you start.
Well, yes. It is my first margin call, like I said, and I am going to take it from the big bad Palantir, the founder of Palantir. He's saying that he dreams about crushing the enemies of America and making them fearful. That's what he wakes up and think about every morning. And it's a bit extreme, if
you get rinsed for it as well.
Yeah, like
destroyed for these.
Sure enough, like he's American, like data guy, and he talks about crushing and destroying the enemies. But imagine if someone who looked like me, like with my beard, came on and like I wake up in the morning and I dream about crushing my enemies. MI5 would be banging at my door like straight away. Like the guy's just getting away with it, and I'm not having it. I'm margin calling him.
You're going to margin call him. Brilliant, love that. Good debut, strong debut.
Thank you.
But I mean, look, but let's link it back to bias. The stock price is roofing.
Yeah.
Right? So he's coming out with all this wild stuff. It doesn't mean the share price is going to come down.
No.
So don't wreck yourself because you disagree with him.
Because the results, the figures came out were super positive. They beat the estimates.
Shawnee?
I have to let you go because my original one didn't make it through the pre-show sort of censor.
Pre-show screening.
Yeah, it got edited. Couldn't make the cut.
Something to do. Well, let's give him.
No. Let's just move on.
Let's just say there's headlines about something to do with the colour blue the last couple of
let's
days,
move
right?
on.
Yeah, we'll move on. For me, I'm margin calling the Grammys. Right, the Grammys just come in. I'm a big fan of hip hop. Ronni, I introduced you to Dochi. She cleaned up. Our boy Kendrick did well. Who did? I mean, the Grammys themselves, right?
I didn't get included in that, by the way. I just got overlooked there.
Oh well, there's no drill. There's no drill category on the Grammys.
Garage more your
Sean
thing.
is a driller.
All urban music.
Well, actually, do you know what? I've been getting really into Tribe Called Quest this week.
Old school, like that. Yeah.
Tribe Called Quest and the Roots has been playing in the Moore household. But I'm going to blame the Grammys. Kanye West. Did anyone see Kanye West's, let's call it a stunt on the red carpet? Well, let's say it wasn't specifically Kanye, but it was more his wife. Bianca Censori was wearing the new Ye female dress that left a little bit more to be revealed. Anyway, she turns around with a fur coat, drops it, and she's pretty naked.
Wait, Kanye was in that pic?
Yeah. So they got booted out. The Grammys didn't have it. They said, "Put your coat on. Come on, you can't do this. This is a kid show. Get rid of them." They got booted out. Yet Kanye and Bianca have been trending more over the last 3 or 4 days as a result. And the Grammys, come on, taken out.
It's 2025.
But this is their thing, right? She does it all the time, doesn't she? I'm sure. I'm sure I've seen her like in Venice and whatnot, and like just being told to put clothes on.
Sure. Look, you did one about porn the other week. I'm slightly worried about your search history.
On the Grammys, I would say, who is it? The Smith. What's his name? The young one.
Sam Smith.
No. Jaden Smith. He's got the like castle on his head.
He's just weird.
What is that all about?
He's just weird.
It's called Fashion Guys. You clearly don't get it.
Yeah, sorry.
I mean, Will Smith is your dad.
Sorry,
so...
my black chinos and grey jumper.
Yeah, for everyone watching on the stream, this is Sean's uniform. There's a fashion trend called the uniform. So you wear the same thing and you expect it, right?
Yeah, this is my uniform.
Well, it started with like the tech bros, right? Steve Jobs, Mark Zuckerberg. Only difference is they wear like designer T-shirt for $300, and not the H&M one.
Yeah,
not that Sean is wearing H&M. This is silk. Yeah,
exactly.
You walk on the trading floor. We're Long Charles Turret and probably Uniqlo as well. Guys, thank you. Guys, thank you very much. That has been an absolute pleasure.
Who won?
Oh no, I think we're off the winnings and the losing.
No voters then. I used to win all the time, right?
You did used to win all the time, yeah. Only because you kept talking about your PA trading account.
No, that was Pete. Shout out to Pete.
Shout out to Pete. R.I.P. Ronni, I think you did well.
Yeah,
thank you, sir. Thank you. Yeah.
If you have any feedback, please comment. I'm going to do the like and subscribe thing, but what we're trying to do is we're trying to build this community of people to talk about trading in the light of how it should be, and not just the panacea of profitability, right? It's real. We need to talk about it. please, from my perspective, please like and subscribe to this show on wherever you get your podcasts. It's been a pleasure. Next, we're going to continue talking about psychology, or we're going to talk about stops. So yeah, look, guys, thank you very much. See you next time.
Sayonara.
Nice one.